Well, good morning, everybody, and welcome to a exclusive training session with GoPro Trading Academy and yours truly, Ian Giffen, coming to you live from the Garden Route of South Africa, where we've had an absolutely wonderful day. This morning was taking the dog to the beach and having a great swim in the sea. It's still summer. So for those of you in the Northern Hemisphere, fear not, your summer is coming. So bringing you lots of warmth and good feeling from here in the Southern Cape of South Africa. So today's topic is practical risk management for traders. And this is one of the things that's very close to my heart. The reason being is that when most people set out on their trading career, they are told very early on that your number one focus should be capital protection, which is the heart and soul, of course, of risk management. And everybody nods sagely and takes that on board. But I prove over and over again that it's nothing more than lip service, that people are actually paying to that. And certainly once you get into your early stages of learning to trade, unless you are very lucky, and it's actually not good luck, you normally find yourself feeling quite despondent about your performance as a trader. That's normal when you're starting out. You don't expect necessarily to be making a fortune off the bat. But nevertheless, I find that the focus of the new trader very quickly moves away from anything resembling true risk management to simply trying to make sure that they get their account into the black and that they're making profit. And of course, on the surface of things, it might seem that that is the same as managing risk. If your account is growing steadily every day, then surely uh, that means that you are less likely to blow your account. Now, unfortunately, nothing could be further from the truth because as traders, we're dealing with an environment that is extremely volatile, so much so that the worst thing that can happen to you as a trader, certainly I can say almost guaranteed, has not yet happened. And unlike when you're in, let's say, a casino type environment where the scope of potential outcomes is limited, in trading there is no limitation on what can happen. And of course, that's what Mark Douglas says in his book Trading in the Zone, as the first of his 5 fundamental principles of trading is anything can happen. Now, that's not true if you're playing blackjack or roulette or rolling the dice or flipping a coin. Because if you're flipping a coin, there's only one of two things that can happen, heads or tails. So um, you obviously you can risk more on heads coming up and so on, but nevertheless, you know what those parameters are. They are within your knowledge and control. Whereas in a trading environment, that is completely not the case. So what today is about really is just broaching some of the topics around risk management. It is a very broad topic, but then having said that, it's very defined as well. We know exactly what the different areas of risk are, but it is nevertheless a wide topic, and I won't be able to spend any more time today on anything other than just a couple of absolutely essential risk principles. So um, most of us are focused on visible risk. I will be starting there, even though hidden risk is very often what will take the trader out at the end of the day. And so it's essential that we do cover that topic, and we will in the future. But let's start at the level of something that is more obvious. So first and foremost, I think when it comes to the practical application of a convex optionality curve, and you guys, I'm sure, have heard me talk about convexity many times. Well, the practical side of that is certainly limiting downside on your individual trades. It does, there is a broader reach to applying convexity across your account. So ensuring that you limit correlation in your trades as well across different instruments is an important part of overall convexity. Likewise, having diversity in terms of your strategy. So having more than one strategy, but not just with a sort of a random intent, with a very focused intent of looking to, first of all, limit downside and therefore help maximize upside, which is, of course, is the heart and soul of convexity. So that's why we have core and overlay strategies, where the core strategy is there to make money and the overlay strategy is there to reduce the depth of the drawdown on one's account. So which brings me to the question as to what is risk. And I will be repeating this in the future, but I'm going to point it out now and say it again and again. When it comes to trading, the only risk we really care about is blowing your account. There's obviously, I mean, it stands to reason. However, when you get into all the academic topics around risk, and you talk about Sharpe ratios and Kalmar ratios, which is one of my personal favorites, and so on and so forth, it's quite easy to lose focus on the fact that the only thing that matters is staying away from losing your account. Now, you have to be careful in this because, again, as I started out saying, what most people would immediately assume is that, well, the best way to protect myself from blowing my account is to try and make sure that every trade wins. And paradoxically, that's the worst possible thing that you can do, because that is impossible. You are dealing with the fundamental unknowable unknown. And so it is absolutely impossible to avoid losers altogether. And in fact, by trying to do so, as you know very well by now, you build enormous fragility into your trading approach and therefore into your account, and kind of almost guarantee that you will blow your account. So it sounds like a paradox, and I hope that you appreciate that paradox, because unless you do, you won't start asking the right questions as to how we can overcome this, how we can reconcile this paradox. And again, that is a much deeper topic for us to delve into elsewhere. But when it comes to the very simple application of a convex optionality or strategy that offers you convexity, the most important thing is to ensure that you are limiting downsides initially aggressively. You don't want to do it in a way that's going to cost you too much. There's always a balance, but your rule set, the set of rules that you follow, should have this dual goal in place. First of all, to look to get rid of the risk as quickly as possible, but by the same token, it should also allow your trade as much chance as possible to actually go on and hit your take profit and give you an upside. So there's a trade-off there. If you're too aggressive about limiting your downside, I'm sure you've experienced this. If you move your stop to break even too soon, you'll often find that the trade gets stopped out of break even and then carries on to what would have been your take profit. And if there's one thing worse than having a loser, it's missing out on a nice big fat winner. And as a professional trader, our focus is actually on not missing the winners rather than avoiding the losers, because our winners are so big relative to our losers. So that's what we're talking about here. So let me just come back to my monitor. We're looking at, in fact, here one of the accounts for one of our members who just started out on the evaluation account for the $2 million funded account, and you can see they're doing not too bad at all. But I'm going to actually show you how, even though they're already basically 1% up on this account, a couple of things that they've done wrong, in fact. So let me just move the screen a little bit so I can get in there right. One of the things that you need to do when you are applying a strategy that gives you convexity is to give yourself as much room as possible to limit your risk, and also as much room as possible to hit your take profit. So one of the mistakes people make very often is jumping into a trade. Let me just check what's happening with the questions here. Okay, all good. Jumping into a trade when in fact the ideal entry has passed. So for those of you who've done my training, for instance, on the daily impulse strategy, you will know that the first thing we look at, obviously on the higher time frame, being the weekly time frame, is do we have reason to believe that we're in an impulse wave on weekly? Clearly here, the answer is yes. So at the start of this week, and in fact, we spoke about this in the Monday market review yesterday, you really need to be looking to enter the market at open as soon as those conditions are fulfilled. Now, that was Friday's candle. So you can see the 19th, and yesterday being the 22nd. Friday's candle gave us that final setup. Basically, it fulfilled the final setup requirement. So the higher time frame conditions were met. The final execution time frame condition was that we should have an impulse candle, and that was given to us on Friday. So in yesterday's market review, I spoke about this, and I mentioned that you really needed to have already entered the market at open, but even then you had opportunity through the course of the morning to get in at even a slightly better price had you missed that. But regardless, that was where you should have got in. Now, why am I pointing this out as a risk management issue? Well, you can see how this member only got into the trade this morning, or at the close of yesterday's candle. So the problem there is now twofold. First of all, they haven't been able to position their stop below the support level. They've needed to use the ATR rule. And that has done two things. First of all, if you are below the actual higher time frame support level, which is here, then your initial stop is safer. Secondly, the reward to risk ratio, instead of being about 1.5 to 1, would have been about 2 to 1. So your initial reward to risk ratio has been eroded. And there's two sides to that. There's reward, but there's also risk. And the reward to risk ratio is a combination of the management of your upside as well as your risk. So practical risk management, this comes into it as well. So getting into a trade late makes your trade more vulnerable immediately. And on top of that, you've eroded your reward to risk ratio and therefore your long-term expectancy, even if the trade wins. So that's the first part of it. The second part of it, however, and by the way, the take profit is also further away. So, it makes it harder to hit take profit as well. Now, there's actually risk involved in that. Why would you take a trade? Well, you're risking some of your money in order to potentially gain something. But there's a risk in terms of not gaining that something, which in this case is hitting your take profit. So the further away your take profit is, the higher the risk that you're not going to hit it. So by getting into the trade late, by chasing after the trade, as I call it, you're actually making it more difficult for yourself to actually hit the take profit, and therefore you're increasing your risk of not doing so. So that's the one aspect of it. The second aspect of it, in fact. The third aspect is comes down to the risk management. And of course, with the daily impulse, we have a methodology, a trailing stop methodology, which is all about trade management. And the trailing stop is there to reduce risk aggressively down to break even as quickly as possible within reason, so as to give the trade a chance to hit its take profit. Now, by getting into the trade one day late, what this trader has done for themselves is made it more difficult for them to be able to reduce their risk. Now, had we entered, as you should have done, entered on the open of yesterday's candle, your initial stop would have been below the low here. And using our 2-5-step rule, at the close of yesterday's candle, you'd have immediately been able to trail your stop to below the low of Friday's candle, which gave us that impulse candle. Now, by doing that, as of this morning, in fact, you would have reduced your risk from, in this case, around 90 pips to about 30 or just over 30 pips. So well under half of the risk would have been, well over half, I beg your pardon, of the risk would have been removed by today. Whereas now this trader is still sitting on a full 1% risk instead of a 0.3 risk, 0.3% risk, and it's more difficult for them to hit their take profit now. And of course, they're having to sit with this open risk for an extra day as well. So obviously tonight, the trader will be able to trail their stop to below that same candle. But instead of an open risk then of just over 30 pips, it's going to be an open risk from that entry down to here of more like 80, almost 80 pips. So a huge difference, as you can see. It changes the complexion, if you like, of the strategy altogether. And in fact, by doing this, you're not conforming to the rules of the strategy. So we have a rule set here which focuses on the principle of convexity, which is all about being able to limit downside and maximize upside. And part of that, in this case, is making sure that you get in correctly, and having done so, then being given the opportunity to limit your downside, reduce your downside down to break even much more quickly. Whereas by entering one day late, it's that much more difficult. I mean, it's actually vastly more difficult to make the trade work. And if you look at it over a longer period, if you look at multiple trades using the law of large numbers, this actually doesn't work. The edge that we have a robust one, but it doesn't allow for this kind of abuse. So you know who you are, and nothing personal. More than one of you guys have done it, actually. I've seen by going through your accounts. So I'm just using one account here as an example. But that is a very important, but as I say, practical element of risk management in your actual trading. So that's really the most important element of, as I say, practical risk management that I wanted to discuss today. There is so much else to the topic, and we do cover a lot of it in the members group as well. So the more advanced elements of it, particularly when it comes to mindset, because at the end of the day, believe it or not, your number one biggest risk is you. Your inability to follow rules, and this is a human thing, so it's not an accusation, it's just something that we all have to deal with. The propensity in terms of the human condition of self-sabotage in the face of uncertainty. And that's obviously a dominating factor in a trading environment, is how one deals with uncertainty. All right, folks. So hopefully you found that useful. If you do have any questions for me, please do drop them into the comments below. It's a subject that I will be looking to expand on in the future. If there's anything in particular that you'd like me to clarify, please feel free. I'd be very happy to do that. Also bear in mind that we do have a mastermind training coming up in a few weeks' time. So if you haven't yet signed up for that, please make sure that you do. We are going to be covering some of these topics, certainly on day one, in principle, in some more detail, but likewise, the practical application, as always, of these principles is something that we will be talking about also during the course of day 2 and day 3. So make sure that you're there. As you may or may not know as well, the mastermind is going to lead into the launch of our next challenge. We're going to have a trading challenge, and in that trading challenge, we're offering very exciting prizes, not least of which is a $10,000 real money live account for you to trade and evaluate yourself on at no cost to you. And if you pass that evaluation, you can build it up at zero risk to yourself to a $2 million live account. Now, if that's not something that can change your life, I'm not quite sure what there is that could. All right, so I hope you guys have enjoyed this. As always, I hope that you have a great trading week further. Please do drop those questions into the comments below. All right, bye for now, and God bless.